Imagine it's October 2019. You're a 48-year-old civil engineer in Beirut. You've spent 25 years building a career, and by the standards of most countries in the region, you've done exceptionally well. You own an apartment in Hamra. You have a savings account at Blombank with $180,000, money you earned dollar by dollar over 2 decades, money you didn't spend on cars or vacations, money you saved because your father told you that in Lebanon. The only thing that protects you is what you've accumulated. You have government bonds. You have a pension. You've done everything right. On the morning of October 17th, you open your phone to news of protests in the streets. Within weeks, the banks impose informal capital controls. You can withdraw $200 per week from your own account, then $100, then nothing at all. The buildings are open, the logos are lit, the bankers are still wearing ties, but your $180,000 is gone in a functional sense, locked behind a wall of administrative rules that no one voted for, that didn't exist 6 months ago, and that you have no legal mechanism to challenge. By 2021, the Lebanese pound has lost 90% of its value. The banks are converting dollar deposits to pounds at official exchange rates, bearing no relationship to reality. Your $180,000 savings account, in real purchasing power, is worth perhaps $18,000. Not because anyone stole it in the traditional sense, because the rules changed, the framework shifted. The administrative apparatus of a government entering fiscal collapse reached into the system and consumed what was accessible. You sit in your apartment in Hamra, and you understand something that millions of people across history have understood too late. You don't own what you think you own. You hold it, you maintain it, you pay taxes on it. But when a government becomes desperate enough, the distinction between ownership and custodianship disappears, and it disappears faster than anyone believes possible. But here is what makes this story different from most. Because you have a colleague, a French structural engineer you met at a conference in Lyon in 2009, and that relationship led to consulting work, which led to a small account at a bank in Paris. You speak 3 languages. You have skills that are not Lebanese. They are universal. You know your neighbors, actually know them, have helped them, owe them things, and are owed things in return. You have, without ever framing it this way, positioned a portion of your life outside the reach of the system that is now consuming everything inside it. You lost what was inside the system. You kept what was outside it. This video is about what couldn't be taken, not what shouldn't have been taken, not what it was illegal to take, because legality is rewritten in a crisis. It always has been. The question is architectural, structural. Which assets, by the physics of how they exist, resist confiscation, seizure, freezing, and forced conversion? The answer is not hidden. It is documented across every major financial collapse of the last 100 years. The pattern repeats with the precision of a mechanism, and once you see it, you cannot unsee it. Before we go through the 5 assets, you need to understand how governments actually seize assets in a crisis, because most people have the mechanism completely wrong. They imagine soldiers at doorsteps. They imagine dramatic scenes of confiscation. Sometimes that happens. But it is the least efficient method, and therefore the least common. The primary mechanism of government asset seizure in a financial crisis is not physical force. It is administrative access. When you deposit money in a bank, you no longer own that money in any meaningful legal sense. You have made an unsecured loan to a financial institution. What you hold is a claim, a number on a screen, subject to the regulatory framework of the jurisdiction your bank operates in. In a crisis, that framework changes. The rules move. The money doesn't have to. Cyprus, 2013. The government didn't send soldiers to anyone's home. They announced a bail-in on a weekend while banks were closed. Depositors at Bank of Cyprus lost 47.5% of their savings above the insured threshold, not through theft, through a rule change, through a mechanism that had been quietly written into European banking resolution frameworks years before it was deployed. Argentina, 2001. The Corralito froze bank accounts, then forced the conversion of dollar deposits to pesos at an artificial exchange rate. A person with $100,000 in an Argentine bank on December 1st had the equivalent of roughly $25,000 by February. The government didn't steal. It converted. It redefined. It administered. Greece, 2015. Capital controls imposed overnight. Citizens could withdraw a maximum of 60 euros per day from ATMs. If you cannot access your money, you do not have money. You have a number. This is the pattern. Governments don't need to take your assets if they can redefine them, freeze them, convert them, tax them retroactively, or simply change the rules under which you can access them. The question becomes structural. Which assets exist outside, not the legal reach of government? Laws can be written to cover anything, but outside the practical, enforceable, administrative reach. To understand the answer, you need to understand one concept that I want you to carry through this entire video. I'm calling it the administrative graph. Modern governments do not govern people directly. They govern through systems, banking systems, tax systems, property registration systems, employment records, brokerage accounts. These systems create a complete map of every citizen's financial existence. Every asset that sits within this map is visible and reachable. Every asset that sits outside it is, to varying degrees, invisible and inaccessible. Seizure requires two things: visibility and administrative access. Both are necessary. If a government can see your asset but cannot reach it, that's the foreign jurisdiction case. If a government can theoretically reach your asset but cannot see it, that's the physical possession case. If a government can neither see it nor reach it, that's the knowledge and social capital case. The 5 categories we're about to cover share one property. They exist outside the administrative graph. That is not coincidence, that is structure. And one more thing before we begin. An insolvent institution, whether it is a government, a corporation, or a pension fund, will consume accessible resources to survive. This is not ideology. It is the institutional equivalent of a biological imperative. Survival overrides principle. It always has. The United States government in 1933 was led by Franklin Roosevelt, widely considered one of the most popular and well-intentioned presidents in American history. He signed Executive Order 6102, requiring citizens to surrender their gold anyway, because the gold reserves were depleting and the dollar peg was unsustainable. Good intentions do not change math. Good intentions never change math. The first asset is the one nobody lists on a balance sheet, and it is the single most seizure-resistant store of value in human history: knowledge and skills. When the German government began requiring the surrender of gold holdings in 1933, when bank accounts were frozen, when businesses were expropriated, when properties were levied and bonds became worthless, there was one category of asset the apparatus of the state could not touch: the skills embedded in human beings. Doctors, engineers, physicists, chemists, mathematicians, musicians. It did not matter what the credential was. What mattered was that the productive capacity was stored in the nervous system, and the nervous system crossed every border intact. Albert Einstein arrived in the United States in 1933 with virtually nothing in material terms. Within weeks, he held a position at the Institute for Advanced Study in Princeton. His wealth was not in a bank. It was in his brain. That asset appreciated the moment he crossed the border, and no executive order could touch it. No capital control could freeze it. No administrative mechanism could reach inside his skull. Einstein is the famous example, but the pattern holds at every level. The surgeon who fled was still a surgeon. The engineer who fled was still an engineer. The baker, the mechanic, the teacher, the electrician. Their productive capacity moved with them because it was them. The Vietnamese boat people of the late 1970s and early 1980s, over 1.5 million people who fled by sea with nothing, often literally with the clothes they wore, represent the same pattern on a massive scale. Within a single generation, the Vietnamese diaspora in the United States, Australia, France, and Canada rebuilt with a speed that consistently surprised researchers. The mechanism was not charity and not government assistance, though. Those played a role. The mechanism was skills. Tradespeople, teachers, merchants, former military officers, they carried functional knowledge that translated across borders. A tailor is a tailor in Saigon or in San Jose. When Castro nationalized every private business in Cuba beginning in 1959, Cuban professionals lost everything in a legal sense: property, bank accounts, businesses, the physical manifestation of decades of work, all confiscated or forcibly converted. The Cuban exile community in Miami rebuilt from zero to become one of the most economically powerful diaspora communities in the Western Hemisphere within a generation. Doctors whose credentials weren't initially recognized became nurses, then passed their boards. Lawyers became paralegals, then passed the bar. Engineers started in drafting rooms and returned to engineering. The credentials were jurisdiction-specific. The underlying knowledge was not. During the hyperinflation of Weimar Germany in 1923, the Mountgasts, professionals who recovered fastest after the currency destruction, were not the ones who had successfully hedged with foreign currency, though that helped. They were the ones whose skills remained in demand regardless of what the Reichsmark was doing. A baker still needed to bake. A doctor still needed to treat patients. A mechanic still needed to repair machinery. The currency changed. The need didn't. Over 7 million Venezuelans have fled their country since 2015. The professionals among them, the doctors, engineers, software developers, have found employment across Latin America and beyond. Venezuelan doctors work in hospitals in Colombia, Chile, Argentina, and Spain. Their medical knowledge crossed borders that their bank balances couldn't. Studies of refugee integration consistently show the same result. Refugees with professional skills reach employment and economic self-sufficiency at 3 to 4 times the rate of those without transferable skills within the first 2. years of resettlement. The distinction that matters here is between institutional knowledge and functional knowledge. Institutional knowledge is jurisdiction dependent. A law degree from Caracas has limited utility in Miami. A medical license from Damascus isn't automatically recognized in Berlin. These credentials are pieces of paper issued by institutions within a jurisdiction. They can be revoked, unrecognized, or rendered meaningless by the collapse of the issuing authority. Functional knowledge is universal. The ability to weld, the ability to write code, the ability to grow food, the ability to repair engines, to diagnose illness, to negotiate, to teach, to build. These have been liquid in every civilization, in every century, in every crisis without exception. What you can do with your hands and your mind is what no government has ever successfully confiscated. The mechanism is neurological. A skill stored in your brain and your hands cannot be administratively accessed. There is no registry for competence. There is no seizure order for the ability to set a broken bone. No capital control can freeze the knowledge of how to wire a circuit. No bail-in can convert what you understand into something worthless. In a world obsessed with financial assets, with portfolio allocations and yield curves and basis points, the single most collapse-resistant, seizure-proof, border-crossing store of value is something you can acquire for the cost of time and discipline. And yet, almost no one frames skill acquisition as asset protection, because it doesn't show up on a brokerage statement, because you can't chart it, because no financial advisor earns a commission on it. That doesn't make it less real, it makes it less visible. And in a seizure environment, invisibility is the point. The limitations are real and should be stated clearly. Skills require a functioning economy to monetize. A surgeon in a war zone with no hospital has a skill but no income. Technical. Skills depreciate without maintenance. Skills are not liquid in the short term. You cannot sell your knowledge of structural engineering for groceries tomorrow. And skills require a destination. They transfer across borders. But transferring requires crossing a border, which is not always possible. The second asset is the one that everyone thinks of first. They are half right. Portable physical assets held outside the system. Gold has functioned as a store of value for over 5,000 years. It is dense, meaning high value per unit of weight. It is durable, it does not corrode. It is universally recognized. It is divisible. In physical form, it has no counterparty risk. These are not speculations. They are metallurgy and history. But the form in which you hold gold is everything. The form determines whether it protects you or exposes you. In April 1933, Franklin Roosevelt signed Executive Order 6102, requiring all persons in the United States to deliver their gold coin, gold bullion, and gold certificates to a Federal Reserve Bank by May 1st. The penalty for noncompliance was up to $10,000, roughly $220,000 in today's terms, or up to 10 years in prison. Enforcement was imperfect. Many people didn't comply and were never prosecuted. But the people whose gold was in bank safe deposit boxes and registered vaults, in any institutionally custodied form, had no choice. The banks complied on their behalf. The individual's intention was irrelevant. The custodian's compliance was sufficient. This is the core principle. The seizure resistance of a physical asset is inversely proportional to its institutional visibility. Gold, held in your own possession in a location known only to you, is structurally different from gold held in a registered vault. Not legally different, structurally different. One can be administratively seized with a phone call to the bank. The other requires a physical search of a specific location that authorities must first identify, then access, then find. These are not equivalent challenges. Indian households hold an estimated 25,000 tons of gold in private hands, more than the combined gold reserves of the United States, Germany, the International Monetary Fund, Italy, and France. The majority of this gold exists outside any institutional framework. Family jewelry passed through generations. Small bars stored at home, gold given at weddings and never registered with any government database. Despite multiple attempts by successive Indian governments to tax, register, or control private gold holdings, the sheer scale and distributed nature of the holdings has made comprehensive enforcement practically impossible. When the Indian government demonetized 86% of circulating currency overnight in November 2016, gold prices surged immediately. The asset that could not be demonetized became the immediate refuge. During Argentina's Corralito of 2001, Argentines who held physical gold at home maintained their purchasing power through the worst of the crisis. Those who held gold in bank safe deposit boxes discovered that safe deposit boxes were not outside the system. They were inside the system in a locked room that the government could access with a single court order. The same asset in two different locations produced two entirely different outcomes. The gold didn't change. The accessibility changed. In Zimbabwe, during the hyperinflation of 2007 and 2008, when the Zimbabwean dollar was losing value so fast that the government was printing $100 trillion notes, Informal gold markets emerged where grams of gold were exchanged directly for fuel, food, and South African rand. The formal banking system was non-functional. Physical possession of a universally recognized store of value was the difference between eating and not eating for a significant portion of the population. Beyond gold, there's the category of gemstones. Diamonds above a certain quality threshold are the most concentrated. Portable wealth ever created by nature. A single 1-carat D flawless diamond can be worth $15,000 to $20,000 and fits inside a shirt button. Documents from refugee studies and historical accounts across multiple conflicts describe families fleeing with diamonds sewn into coat linings, hidden in shoe soles, concealed in ways that metal detectors could not find and customs agents could not easily identify. A Belgian Jewish family fleeing in 1940 converted diamonds to local currency at successive stops across 4 countries, using what they carried in their clothing to fund survival for 3 years until they reached safety in Portugal and eventually Brazil. The mechanism was physics, an asset small enough to conceal, valuable enough to matter, and unregistered by any government system. The limitations here require stating directly. Physical assets outside the institutional system are illiquid in normal times. Authenticating gold or gemstones requires expertise. Physical assets can be lost, stolen, or destroyed. They carry legal risk in many jurisdictions, if undeclared at borders. And critically, the property that makes them seizure resistant, their invisibility, also makes them fragile in ways that registered assets are not. There is no recovery mechanism if they are lost. There is no insurance claim. The inescapable trade-off is this: there is no asset that is simultaneously liquid, safe, visible, and seizure-proof. Those properties are in structural tension with each other. The most convenient asset is the one most easily seized because convenience requires institutional infrastructure, and institutional infrastructure is what governments control. Anyone who offers you an asset that avoids this tension entirely is selling something. The third asset is the one that did not exist before 2009, and it changes the calculus in ways that are genuinely new. Decentralized digital assets. I want to be precise about what matters here, and it is not the price, not the speculation, not the narratives that surround cryptocurrency. One structural property only. Bitcoin and a small number of similar decentralized cryptographic assets have one characteristic that no previous asset class in human history has possessed. They can be stored in your memory. A Bitcoin wallet is controlled by a private key. That private key can be represented as a sequence of 12 or 24 common English words, called a seed phrase. If you memorize those words, you carry access to your assets in your brain. There is no physical object to confiscate. There is no account to freeze. There is no custodian to compel. There is no border crossing that requires declaration. A person can walk through any airport in the world, cross any international checkpoint, pass through any security apparatus, carrying the access to substantial stored value accessible only through a sequence of words that exist nowhere but their own memory. No scanner detects it. No search finds it. No court order can freeze it, because there is no institution to serve the order to. This is not theoretical. It has been documented repeatedly in real crises. Chinese citizens have moved wealth past the country's strict capital controls using memorized seed phrases. China limits foreign exchange transfers to $50,000 per person per year. Cryptocurrency provided a channel that capital controls could not block at the protocol level. Venezuelans crossing into Colombia with nothing have carried savings stored in memorized words. When your bank account is frozen, your currency has collapsed, and you are crossing a border with one bag. A memorized seed phrase represents savings that no checkpoint can detect. After the Taliban takeover of Afghanistan in August 2021, traditional banking channels froze simultaneously from 2 directions. The Taliban restricted them from inside. International sanctions froze them from outside. Afghan citizens and civil society organizations accessed funds through decentralized wallets that neither the Taliban nor the United States nor any international body could touch. The formal financial system failed for contradictory political reasons simultaneously. Decentralized assets were the only ones that functioned regardless of who held political power. When Russia invaded Ukraine in February 2022, the Ukrainian government received over $100 million in cryptocurrency donations within days, bypassing traditional banking channels that had been disrupted by the conflict. Ukrainian civilians in occupied territories with frozen bank accounts could still access decentralized holdings. The technology proved politically neutral in the most relevant sense. It resisted seizure regardless of which side of the conflict you were on. In Nigeria, in February 2021, the central bank banned cryptocurrency transactions through banks. Peer-to-peer cryptocurrency trading in Nigeria increased after the ban was announced. The prohibition applied to banking infrastructure. It could not apply to the cryptographic protocol itself. Nigeria subsequently became one of the highest per capita cryptocurrency adoption countries in the world. not because Nigerians were particularly ideological about decentralization, but because trust in the formal banking system was historically low and the alternative worked. The mechanism is architectural. There's no server to shut down. There's no CEO to subpoena. There's no headquarters to raid. The network is distributed across thousands of independent nodes in dozens of countries. Seizing Bitcoin is not like seizing a bank account. It is like seizing an idea. You can criminalize the behaviors around it. You cannot confiscate the asset itself if it exists only as a memorized sequence of words. The historical parallel is imperfect, but instructive. Physically held gold in the 1930s had a similar profile. It was difficult to seize, but also difficult to spend. You could not walk into a grocery store in 1934 with a gold coin and buy bread. You needed to convert it, and conversion points were monitored. Maximum seizure resistance has historically come at the cost of maximum friction in daily use. The limitations must be stated fully, because intellectual honesty is the only thing that distinguishes analysis from advocacy. Bitcoin has dropped over 70% on multiple occasions. In 2022, it fell from roughly $69,000 to under $16,000. Seizure resistance means nothing if the value evaporates on its own. If you forget your seed phrase or store it improperly or make an error in a transaction, the assets are gone permanently. There's no customer service. There's no recovery mechanism. The same architectural property that prevents government seizure also prevents personal recovery. That is not a flaw, it is the architecture. And governments are not static. The on-ramps and off-ramps, the exchanges where people convert between crypto and traditional currency are increasingly regulated and, in some jurisdictions, shut down entirely. The European Union has imposed extensive reporting requirements. The United States Treasury has proposed rules on self-hosted wallets. China banned crypto trading outright. The asset itself resists seizure. The ability to use it, to convert it into goods or local currency, depends on infrastructure that governments can and do control. The fourth asset is the one that the wealthy have understood for centuries, and that the middle class almost never considers until it is too late: foreign-held assets in stable jurisdictions. The principle is simple. A government's administrative power ends at its borders. An Argentine citizen who held $100,000 in a Buenos Aires bank in November 2001 lost the majority of that value through forced conversion during the Corralito. An Argentine citizen who held $100,000 in a Montevideo bank, 90 minutes away by ferry across the Rio de la Plata, lost nothing. Argentine law did not apply to it. Argentine capital controls could not reach it. Argentine forced conversion could not touch it. Same person, same amount, same currency, different jurisdiction, entirely different outcome. Before the collapse of the Weimar Republic, wealthy German industrialists held assets in Switzerland, Sweden, and the Netherlands. When the hyperinflation destroyed the Reichsmark, when the currency literally became worth less than the paper it was printed on, those foreign-held assets retained their value in full. The same families that were wiped out domestically survived through geographic diversification. The wealth didn't survive because of financial sophistication. It survived because of jurisdiction. An estimated 40 to 80 billion euros left Greek banks in the months before capital controls were imposed in 2015. The money went to banks in Germany, the United Kingdom, Switzerland, and Luxembourg. The people who moved early kept what they moved. The people who waited, who trusted that the situation would resolve, who believed their government would find another way, lost access to their own savings for weeks, some for longer. The pattern is not that those who moved were smarter. The pattern is that they understood that the government's reach had borders. Lebanese citizens with funds in Dubai, London, or Paris in 2019 suffered no loss from the Lebanese banking crisis. A court order from Beirut does not bind a bank in Singapore. A decree from Buenos Aires does not freeze an account in Zurich. This is not a technicality. This is the architecture of sovereign jurisdiction, and it is held in every financial crisis in modern history. The 2022 freezing of Russian central bank reserves, roughly $300 billion in assets held in Western jurisdictions, is both a confirmation and a complication of this principle. It confirms that foreign assets are protected from your home government's seizure. It also demonstrates that you are then subject to the rules of the jurisdiction, holding your assets. Assets held in London are protected from Lebanese law. They are subject to British law. If the political relationship between your country and the jurisdictions holding your assets deteriorates dramatically, the protection can be compromised. The Russian case accelerated global de-dollarization precisely because every other country watching realized their own dollar-denominated foreign reserves could theoretically be reached by American political will. The lesson is jurisdictional diversification, not jurisdictional transfer. Moving all assets from one government's reach to another government's reach is a risk reduction, not an elimination. The foreign jurisdiction must be genuinely stable. It must have strong rule of law, independent institutions, and a historical track record of respecting property rights under external political pressure. Switzerland has served this function for over a century, though its banking secrecy has eroded significantly since 2010 under international pressure. Singapore has emerged as a meaningful alternative. New Zealand and certain Caribbean jurisdictions with robust legal frameworks inherited from British common law have also served this function across various crises. The limitations are real. Reporting requirements exist in most developed countries. Americans must file a foreign bank account report for any foreign financial accounts, exceeding $10,000 in aggregate. Failure to file carries severe penalties, in some cases more severe than the underlying tax liability. Similar requirements exist across Europe, the United Kingdom, Canada, and Australia. These requirements don't eliminate the jurisdictional protection, but they create a record. Records can be used to apply pressure, impose exit taxes, or create new retroactive obligations. And the foreign jurisdiction must actually be stable. Holding assets in a Cypriot bank to escape Greek risk would have been catastrophic in 2013 when Cyprus imposed its own bail-in. Jurisdictional risk is real. It cannot be eliminated by moving assets. It can only be diversified. The fifth asset is the one that no economist charts, no financial advisor mentions, and no government can see: social capital and community networks. In every societal collapse ever documented, across centuries and cultures and political systems, the single largest determinant of individual survival has not been financial assets. It has been social connectedness, the relationships you have built, the trust you have accumulated, the community you are embedded in. After Argentina's formal economy stopped functioning in 2001, when banks were closed, cash was scarce, unemployment exceeded 25%, and poverty rates exceeded 50% almost overnight in a country that had been considered upper middle income, a vast network of barter clubs emerged, called Clubs de Tric. At their peak, these networks involved an estimated 6 million participants. A baker traded bread for a haircut. A mechanic traded repair work for tutoring for his children. An accountant did bookkeeping for a farmer in exchange for vegetables. The people who thrived in this system were not the ones who had the most money before the collapse. They were the ones who had the most relationships. The ones who were known, trusted, and owed favors. When the Soviet Union disintegrated in 1991, the formal economy ceased to function within months. What replaced it was not a new formal economy, but BLAT, the Russian system of informal networks, personal connections, and reciprocal favors that had operated in the shadows of Soviet bureaucracy for decades. People with extensive BLAT networks navigated the transition. People who had relied entirely on the formal system, on state salaries, state pensions, state-distributed goods, were economically devastated. The informal network had existed all along, invisible to any government registry. And when the formal system disappeared, the informal system was what remained. In the period between the end of World War II and the West German currency reform of 1948, the Trümmerfrauen, the rubble women who organized the clearing of bombed German cities, built informal mutual aid networks that shared food, childcare, labor, and information. These networks had no legal structure, no financial accounts, no taxable presence. They were pure social capital. They were the primary mechanism through which millions of Germans survived a 3-year period of near-total institutional collapse. No government administration could have reached these networks because they were not organized in any way a government administration could recognize. Studies of Hurricane Katrina in 2005 showed consistently that the single largest predictor of survival and recovery speed was not wealth, not insurance coverage, not access to government assistance. It was social connectedness. People with strong community ties were rescued faster, received more informal aid, rebuilt sooner, and reported better psychological outcomes than wealthier individuals who were socially isolated. The pattern is not specific to financial collapse. It applies to any systemic disruption severe enough that formal institutions fail or become inaccessible. During the Lebanese banking crisis, communities organized around neighborhood, family, and sectarian networks. Informal credit systems emerged. Shared resources, communal food purchasing, collective bargaining with suppliers. Communities with strong pre-existing bonds navigated the collapse significantly better than atomized urban professionals, even when those professionals had more pre-crisis financial assets. The savings accounts were frozen. The relationships were not. During the Greek crisis of 2010 through 2015, rural communities with strong social bonds and local food production capacity weathered the economic collapse far better than urban Athens. Villages with subsistence farming capability and tight communal relationships experienced the crisis as hardship. Athens experienced it as catastrophe. The difference was not primarily financial. Many village residents were poorer than Athenians in absolute terms. The difference was social infrastructure. The mechanism is domain. Social capital exists in a domain the state cannot administer. It is stored in the minds and habits of other human beings. It is denominated in trust, reciprocity, and shared history. It cannot be digitized in any way that makes it accessible to government systems. It cannot be registered. It cannot be frozen. It cannot be seized. You cannot freeze a relationship. You cannot impose capital controls on trust. You cannot bail in a reputation. You cannot retroactively tax a favor that was given freely. You cannot confiscate the knowledge that your neighbor considers you reliable and will help your family in a crisis because you helped theirs during the last one. These things exist entirely outside the administrative graph. They are the ultimate off-balance sheet assets. The uncomfortable reality in contemporary developed societies is the following. Robert Putnam documented in Bowling Alone, published in 2000, that church attendance, civic organization participation, union membership, neighborhood socializing, even informal dinner parties, had all declined dramatically in the United States since the 1960s. The average American in 2025 has fewer close friends, fewer community ties, and less neighborhood interaction than at any measured point in recorded history, which means that in precisely the societies most likely to face a financial crisis driven by unsustainable sovereign debt, the population is simultaneously holding its wealth in the forms most accessible to government seizure and maintaining its social capital at historic lows. This is not a coincidence. It is a trap. The most financially exposed populations are also the most socially isolated. In a crisis, that combination is devastating. Now, let's step back and look at what all 5 of these categories share. Knowledge and skills, portable physical assets held outside institutional custody, decentralized digital assets, foreign-held assets in stable jurisdictions, social capital and community networks. They share exactly one property. They exist outside the administrative graph. If a government can see an asset and reach it, it will be consumed in a fiscal crisis. Bank deposits, registered property, brokerage accounts, pension funds. These sit inside the graph. They are visible and accessible. History does not provide exceptions to this rule. If a government can see an asset but cannot reach it, that is the foreign jurisdiction case. The protection is real but bounded by the political relationship between jurisdictions. If a government can theoretically reach an asset but cannot see it, that is the physical possession case. The protection depends on invisibility, which carries its own fragilities. If a government can neither see an asset nor reach it, that is the knowledge case, the social capital case, the memorized seed phrase case. The protection is deepest here because the asset exists in a domain the state's administrative apparatus was never designed to access. This is not a portfolio recommendation. It is not a financial strategy. It is a taxonomy, a structural description of what falls outside the administrative graph. And the historical evidence, across centuries and continents and political systems, demonstrates without exception that when a government enters genuine fiscal crisis, it harvests everything inside the graph and cannot reach what is outside it. The United States federal debt currently exceeds $36 trillion. Annual interest payments have surpassed $1 trillion for the first time in history, exceeding the defense budget. The Congressional Budget Office projects that under current law, with no recession, no war, no additional crisis, the debt-to-GDP ratio will exceed 150% by 2050. Bail-in frameworks have been drafted and published in regulatory documents available to anyone who wants to read them. Central bank digital currency development is underway, discussed openly in Federal Reserve white papers. IRS reporting requirements expand annually. Cash transaction reporting thresholds that were set in 1970 have never been adjusted for inflation. $10,000 in 1970 is worth roughly $80,000 today. The threshold is still $10,000. The architecture of the next seizure is being constructed in public, in white papers, in regulatory frameworks, in central bank conference presentations, not secretly, openly. While most people debate whether something like this could happen in a country like this, the mechanisms are being built for a reason that does not require any particular political malice to explain. The math requires it. Insolvent institutions consume accessible resources. That is not politics. That is physics. Return now to Beirut, to the civil engineer in Beirut, Hamra, who lost $180,000 that existed as a number on a screen inside the Lebanese banking system. He lost what was inside the administrative graph, the registered savings account, the government bonds, the pension fund, everything the state could see and reach. He kept his engineering skills, which crossed borders with him when he eventually left. He kept his relationships with colleagues in France and Germany. He kept his small foreign account. He kept his reputation in his neighborhood. He kept what the administrative apparatus of a collapsing government could not map, could not register, could not reach. The pattern across all 5 categories is identical. The assets that survive are the ones that exist in domains the state cannot administer: the mind, the body, the foreign jurisdiction, the decentralized protocol, the community. These are not theoretical constructs. They are historical observations drawn from every major financial collapse of the last 100 years. The people who survived with their wealth and their dignity intact were not the ones who had accumulated the most. They were the ones who had accumulated in the right places. This is historical and educational analysis. It is not financial advice. It is not a recommendation to take any specific action. Every individual situation is different. Every jurisdiction has its own legal requirements regarding asset declaration, tax compliance, and capital flows. Nothing in this analysis should be taken as encouragement to violate any applicable law. What I keep returning to is this. Every generation believes it is exempt from the patterns that governed previous generations. The Cypriot depositors did not believe it. The Argentine savers did not believe it. The Lebanese account holders did not believe it. They held their wealth in the most convenient forms, the most conventional forms, the most institutionally endorsed forms. And they discovered what every generation before them discovered, that convenience and safety are not the same thing, that they are often opposites. That the most convenient asset is the one most easily seized precisely because convenience requires institutional infrastructure. And institutional infrastructure is what governments control in a crisis. The question is not whether your government would do this. Governments do not do things because they choose to be predatory. They do things because the math eventually requires it. The question is whether the math will eventually require it. And if it does, history is very clear about what happens next. It has always happened somewhere. That somewhere was always a place whose citizens believed they were different, that their institutions were stronger, that their rights were more durable. And they were right until they weren't. The pattern is already in motion. The debt is already documented. The mechanisms already exist. The architecture is already being built. The only question that matters is what you hold outside the graph when the graph is harvested. This channel does not predict the future. It reads the past. Because the past has already told us everything we need to know. Most people just don't look at it until they're already inside it. If understanding these patterns before they become personal is useful to you, subscribe, because the next analysis is already being written. And the patterns we cover next are ones you will not find discussed anywhere else with this level of documented precision. The people who understand these systems before they become relevant do not panic when they do. They've already positioned. That starts with knowing what almost nobody else knows.